Hey everyone, welcome. So happy you can make it out today. Today we're going to talk about the process of making winning offers on any type of deal. We're talking about multifamily today, but you know what? This kind of stuff works with pretty much any deal you're doing, all right? So if you don't know me, my name's Agostino Pintus. I am with Bulletproof Cash Flow. Now, I'm an experienced multifamily investor and syndicator, done many deals. So I'm a guy that's actually walking the walk. I do deals all the time. I do big multifamily deals. I do small deals. We do development. We do ground up. We even do net lease. And we also show people how to get into the real estate game. Okay. We show people just like you how to underwrite deals, how to put deals together, where to get the debt, where to get the equity, how to basically get these properties cash flowing in a way to get you and your investors some money, right? Make a nice healthy return on these deals, all right? So that's really why we get into this game, aside from, of course, all the tax benefits and other things that come with it. So the things I'm going to be sharing with you today specifically is how to get into these deals. What is the process of winning the actual deal? Okay, there actually is a process. Right now, the market is very slow, largely due to the interest rates. Okay, interest rates have certainly put a damper on the real estate world. The cost of money, the cost of capital has gone up tremendously. A lot of the investors that would be usually investing in these types of deals, sitting by the sidelines, are kind of like waiting. Your typical lenders are not lending on these deals. Your typical banks, your tier 1, tier 2 banks, your regional banks, your tier 2s are not lending these days. Who is lending? It's usually going to be hard money guys, very expensive money, all right? Regardless, the thing is, in the real estate world, all right, what it comes down to is how much you're paying for it, what work you have to do to it, and what is the cost of capital. You're always making a margin, no matter what. You're always making a margin. The more expensive the capital becomes, the lower the value of the asset goes, right? So what you're looking for is always trying to find a good, strong deal. And then at that perspective, you can figure out what does it look like in terms of adding the debt to it. Now, whether it is doing a hard money loan or doing an owner finance type deal or a land contract type deal, whatever it is, right? Figuring out the various ways of making the deal work so you can actually win the deal. So I'm going to walk you through some of my proven strategies, some of my proven systems of analyzing deals very quickly, determining the value, and structuring a competitive offer so you can negotiate and win the deal. Okay? So that's again a real big part of obviously trying to get the deal done, right? In order for you to actually get the opportunity, you need to be putting out a lot of deals. Okay, so like I said before, if you want to learn more about how to do this kind of stuff, check out themultifamilyadvantage.com. If you're a beginner, if you're just getting into the real estate world and you want to learn how to get into the multifamily game, we do a 50-week mastermind. All right, and we go through the whole thing. We go over stuff like this, but in way greater detail because we're doing at least an hour a week and we have special guests coming on. You're sharing your information, your knowledge with other people in the group, and you guys are all looking for deals, trying to find deals that work and pencil. Yes, even in today's economy, okay? There's always a deal in any market. Doesn't matter. People are always going through stuff all the time. So it's good that you're prepared on how to underwrite deals, right? So let's go ahead and dive in, all right? There's some specific sections here. We've got 4 specific sections we're going to go through. This first one is really getting to analyze a deal very quickly, okay? So the first thing to really consider is and figure out is getting through and looking at a deal very quickly and returning a response to that person that sent it to you, to that agent, to that broker, whoever it is that sent it to you, right? The more responsive you are, people like that. Even if it's a fast no, fine. You have to be able to make a fast yes or a fast no or a fast maybe or whatever, right? But you have to be able to identify very quickly what you're looking at. Okay, what's the first thing you have to figure out, right? So the key is, like I said, looking at deals extremely quickly. So maybe you get a deal package from a broker and you have to determine if it's worth moving on it. And you can usually figure this out in 10 to 15 minutes. Okay, so here's some tips. There's 3 tips you can use to do this. Okay, so the first thing is adjusting the income. So take the gross potential income in the package, deduct 10% for vacancy, credit loss, stuff like that. Just remove that right off the bat. Okay, this will give you a somewhat conservative, effective gross income. Okay, don't use the owner's vacancy. 10% is the rule of thumb. Okay, the owner's vacancy, they'll probably put in 5% or something like that. 7% is sometimes the norm, depending on the city, right? We use 10. Okay, so we want to be building some extra slush in there, right? If you were to take over a property, chances are you're probably going to lose some tenants anyway, right? So right off the bat. And you want to be able to account for that kind of stuff fairly quickly, okay? The second thing you're doing is you're adjusting the expenses. These offering memorandums, these marketing packages, is just like what they're called. It's marketing. It's all marketing. If you look at those OMs, you'll see the pictures are beautiful. They're always beautiful. Not a speck of dirt anywhere. Looks perfect, right? Well, this includes the numbers. The numbers are also all cleaned up as well, right? So what you're going to find is that the expenses oftentimes are way underreported. I've seen expense ratios like 30%. It's not even possible. Like it's not realistic. Even on a brand new asset, stuff that we build is usually 42%, right? 40 to 42 is what you're going to find on a brand new build with nothing wrong with it. So if you guys are doing C-class type of assets, 50% is probably the okay, of the effective gross income, 50% expense ratio, depending on where you are. If you're here in the Midwest, for instance, and you have to pay for some level of heating, especially during the wintertime, winters here can be fairly brutal, and there's a boiler system, for instance, you're going to be closer to 60. Actually, you probably will be in the 60s, 61, 62% of expense ratio, okay? This is oftentimes where I see on these offering memorandums where the broker takes advantage of just like reducing it all the way to juice the numbers, to juice the NOI, okay? So make sure to adjust that properly, okay? And it's going to be way more realistic. So don't just use the T12 that they provide, okay? Don't use any of that. Just this is a rough estimate here of trying to figure this out, figure if there's even a deal here, okay? And then the third thing you do is you can calculate the value, maybe based on a cap rate. Now, cap rate generally is used, in my opinion, to determine a level of risk, okay? And what you're doing in this case is you're using the NOI to calculate if there's even a deal here. So what you do is you take the NOI that you calculated and you divide that by the cap rate promoted to determine a revised value. This will account for a more conservative projection. Okay, so don't rely on the owner's cap rate. Look at the comps in the area. Look at the area itself. Okay, for example, let's say a deal is listed at $1 million and it has $100,000 of NOI. So that's an 8 cap. Okay, so by adjusting the income down 10% to $90,000 of the effective gross income and the expenses up to 50% of effective gross income, okay, the NOI now drops to $45,000. So with that same 8% cap rate, it puts the value at $562,000 versus the $1 million asking price, you see? So the NOI is really what you're looking for, right? The cap rate will, again, tell you what the valuation is of that local market, right? And here's what I mean. If it's a C-class type of deal, typically those types of deals, they trade 8 to maybe 10%, right? 8 to 10% cap rate. A C-class, that's where the C-class is going to be. A D-class is going to be much higher, it would probably be 10 and up, right? A B-class would be typically 6 to 8. An A-class is going to be lower than 6, probably 5s or even lower than that, depending on how new the asset is and what type of asset is it. Is it a luxury asset or what it is, right? So again, getting the right valuation on the right asset is extremely important. All right. I typically don't recommend, if you're getting into real estate for the very first time, do not do D-class assets. Do not do those types of stuff. Okay. It's very, very difficult to run those types of deals. Okay. Regardless, this quick 10-minute analysis allows you to generate an informed offer and provide feedback to the brokers right away, right? So speed is extremely important. If the broker sent you a deal, you can figure this thing out really quick. There's 3 steps and figure out like, what is the valuation here? At least I can have a discussion with them and see like, how are they basing the $1 million? What's it based off of, right? Where are they getting it? How are they getting it? Did you miss something, right? So at least you get to open up the discussion, right? But getting back to them is going to be extremely helpful to opening up that door and building the relationship with the broker, because in order to actually get that deal the very first time, you need to establish those relationships, okay? The best thing to do, in my opinion, is to analyze. I was doing 10 deals a day, at least 10 deals a day in various markets that I was targeting, okay? To really not only learn about the market, but also learn how to use the tools to figure out what is the right valuation, what is the right cap rate, okay? All this is a numbers game. So you have to grind through a lot of deals to figure out what works and what doesn't, all right? So the second part, determining a fair market value. So once a deal passes that initial sniff test, okay, the next step is to determine the fair value. Now, there's various ways that I do it. I look at comps, okay? I try to find 2 to 3 recently sold properties in the area, right? And I try to usually, half mile away. If I have access to their financials, sometimes I do, sometimes I don't, I'll take a look at them. Right? And you might say, how do you get around? How do you get a hold of that? Because I analyze a lot of deals in the same market, okay, what I do is I analyze a deal, I keep a folder, and I put all that data away. And if I ever have to go look at that data down the road, I have access to the last financials. I can go look at it and figure out, like, how did it perform last time? What's it performing at this time, But what it does is, if I'm able to look at the financials, how the other deals are performing, I can figure out what the value is, maybe on a per square foot basis, maybe it's a per unit basis, right? Trying to figure out what the value is there. But brokers will sometimes provide comps, right? But always verify the comps yourself, right? If there's a typical sale that was recently done, you can look on the fiscal officer's website for your local area, and you can see when what it traded for. Okay. The second thing you could do is check out the replacement costs. All right. So calculate the cost if you have to acquire the land and build everything brand new. Okay. So typically these days, to build everything out of wood, for instance, brand new build might be anywhere between $230,000 to $260,000 a unit on the low side. Okay. This helps you establish a ceiling of value, right? To determine, like, what is the real value. The other day I got a deal. It was for only a triplex, and just the asking price was it $250,000 a door just to walk into the unit for these 3 units, and then it needed another $400,000 to fix it because it was totally vacant. I could build brand new. Why would I even do that deal? That doesn't make sense. I could build brand new for far less. So clearly, I'm not doing that deal, right? But again, that's how you get to use that metric, right? The third thing you do is you get a discounted cash flow analysis. Okay, so you project the net cash flows out over a 10-year hold and discount them all the way back to the present, maybe at a 12 to 15% IRR to derive what the real value is. So this means stress testing with a higher vacancy, lowering the rent bumps, that kind of thing. Okay, so a lot of folks out there, I see them do this, right? Say they're looking at a deal, they get very, very aggressive with the rent bumps. Okay, they'll say, oh yeah, we're gonna increase the rents every year at 5%. I wish that were the case. It usually isn't. Okay, especially in a recessionary period that we're in right now. You're not increasing the rent 5%. You're not even increasing it by 3%. You may have to keep them where they're at. Maybe you do a 1% increase. Maybe. That's a big maybe, right? Because you want to keep that resident, that tenant in that unit. You don't want to give them a reason for them to bounce out. You want to just renew and keep them in there, okay? What does that mean? That means you're going to have to take a hit in terms of your rent bump, right? So you have to be prepared for such things, okay? But getting the comps and getting the replacement costs help with figuring out what the potential value range might be. And then I run a 10-year discounted cash flow based on my underwriting to finalize my opinion of what the value truly is. So the key is supporting your value with real market data. Don't just don't just use your gut feel, or rules of thumb or whatever. If you do a little bit of legwork here, which is very easy to do, okay, you can determine the fair market value very empirically, and you can demonstrate it to the broker. Say, look, this is a number. These are the numbers I got. How you get into your number, right? And if your number makes sense, and the broker always wants to see a deal happen because they only get paid when a deal closes. And if they can talk to the seller and show them the data, they may actually sell. They may actually do it. So part of this is on your side as a buyer is to sell them why that number does or does not make sense, right? Third section here is making a competitive offer. So once I have a fair value and I structure an offer that makes sense, all right, it maximizes the chances of me winning the deal. So here's some 5 tips, okay? Earnest money. So I might offer 3 to 5% to show that I'm serious about doing the deal, right? The seller, they really want to see some skin in the game, right? They want to see that you care about the deal. So let's say, for instance, if I'm doing a large deal, like a $10 million deal, I might put up $250,000 on that deal, right? A nice chunk of change. It shows that I'm really serious about getting the deal done. The second thing you do is the due diligence period. So these days, due diligence, it used to take, before all the COVID stuff, it used to take only 30 days for due diligence, 30 days to close. That was normal back in the day, a few years ago. These days, it's a 45-day due diligence, 45-day close, okay? Why? Due diligence periods they've grown significantly because the people that actually do the due diligence, your third-party reports, your inspections, your appraisals, all that fun stuff has taken longer, okay? So what you're typically doing these days is you try to get by with a shorter due diligence if possible, right? And maybe before you lock up the deal, you try to make the phone calls ahead of time and gauge how long it's going to take. But if it's going to take 45 days to do it, if you think you're comfortable doing it in 45 days, then do it in 45 days. Maybe you can offer an extension of some sort in exchange for some money or something like that. Okay. Maybe you need an extra 15 days or whatever. Say, look, if I need an extra 15 days, I'll put up some extra money to make sure that we actually perform, right? The same thing with the financing part too, right? If you do need extra time, put up to buy that time. Don't be difficult. Don't be a jerk. Okay? Don't do that. It doesn't really help you. And it also makes you appear like a newbie, right? Even if you are a newbie, and that's okay if you are, you want to appear like you know what you're doing and you want to structure your deals accordingly, okay? The third thing to do is drop any minor contingencies like pest inspections, things like that, all right? It shows confidence in your underwriting. It shows confidence that you know what you're doing. I had one guy, we're selling some of our deals, and they want to see the report on the pool. Property doesn't have a pool. Like, why do you even have this on your list? Like, oh, but we need you to acknowledge it. It's like, it makes me think like, why are they asking for stuff like this? And why are we even discussing it? There's no pool there, right? It puts doubt in the seller's mind that why would you even ask for something, an acknowledgement of something that doesn't even exist. Right? So your job is to make it as easy as possible. That's what your job is, okay? The fourth thing to do is their title and escrow, okay? agree to use a decent, reliable, preferably national title company, local to the area. This helps avoid any type of errors, problems, delays. Why? Because if you're trying to use some out-of-state type of scenario, out-of-state title company that's not familiar with the laws of the local area, they don't know who to talk to, who the major players are, how do you navigate the laws of that local market. It's going to add time and open up the potential for more problems, more delays. Okay. That's why I deal with national companies that I can still get my discount, whatever discounts I get, and it doesn't matter what market I work in, right? That's just how I do it. I strongly recommend that you do it. So the fifth thing is creative terms. So these days, if you offer a seller financing, it can give you an edge these days, right? It gives you an edge actually as a buyer and possibly for the seller, right? So the thing is that these days, trying to get deals done with a normal bank, believe it or not, adds time. And not to mention it gets to be tremendously expensive. An owner finance scenario, if you're able to sell it properly and package it up in a way that makes sense to the seller, they may go ahead and jump on that boat. A lot of the more sophisticated sellers are already familiar with it, so it wouldn't be that hard of a sell. The thing is that by them carrying the note, they get to enjoy the tax benefits because they don't get that big tax hit right all at once. And if something happens, you don't perform on your obligation, they take the property back. So it's a win-win for them and for you. So you get a better rate, and if you don't perform for whatever reason, they get to keep the property. So you better perform. You better be sure you like this deal. All right. Ultimately is what it comes down to. But the things I like to figure out is beyond price, which is critical. What else do they need? Right? What else do they want to see in the deal? So I try to pick up whatever they need that needs to be in the deal and make sure that it's put in the offer. Okay. So I like to make things very, very, very easy for the seller to make a decision. Right? I structure it so easy, very simple terms, because I wanted to get the deal under control as fast as possible. I'm trying to anticipate any of the terms that the seller wants to see and build them into the initial offer. And I do that. If I can talk to the seller, I will, right? Usually it goes through a broker, but I ask the broker, what are they looking for? What do they need? What would they like? Sometimes I've seen cases where the seller was a big music fan, and they wanted to have they're into guitars or something, and I heard someone actually put in, it's like, here's the offer, and I'll even throw in a brand new a Les Paul guitar, Sometimes that stuff works. I mean, anything goes in commercial real estate. It doesn't have to be always about money. So sometimes it could be that little cool thing that could be negotiated and put into a deal. Okay, so go ahead and do that. As a matter of fact, I have one time I structured a deal. I got to understand who the sellers were. They're very superstitious. So my offer price had a whole bunch of sevens in it. It was $2,777,777 and seven, I forget what it was, 77 cents or something. It had all these sevens in it. Lucky number 7, right? They took my deal over someone else's that was actually more, right? So that's the type of thing that really you try to understand who the seller is. Try to understand who the seller is and what they need to see, okay? And then from there, you go into section 4. You negotiate to win, okay? So you come in strong with an initial offer. It's absolutely critical. But deals are won and lost during the final negotiations. You're negotiating the PSA, okay? So here are some of my top negotiating strategies. So get guidance from the broker on where the other offers are, so you know the ballpark of where you need to be. So, the thing is, so the broker won't always want to tell you what's going on with the other sellers. I mean, technically they're not even obligated to, right? But it depends on the relationship that you have. And you can just tell them, like, look, I really want to win this deal. Tell me what it's going to take to make it happen. And usually they'll say you need to go up a little higher or whatever. They won't give you an exact number, but They'll say you have to be up higher, or you're in the ballpark, or you're not even close. They'll tell you a little bit about that, right? Again, it depends on the relationship that you have, right? And that also means, like I said before, always being present, returning the phone calls, stand on top of the deal, and don't make stupid requests. That's part of it too. Whenever you present your LOI and your PSA, it's nice, clean, it makes sense. You're not asking for ticky-tack things and you're making it sound like it's a real big deal to you, and it really isn't. All you're going to do is frustrate everybody. You don't want to do that. That's how you lose deals, right? Another thing is, don't wait until the final hour to submit your final deal. Okay, so wait all the way to the end so you have all the latest intel. A lot of people do this. Okay, so you have to be prepared for this. Usually there's going to be some sort of call for offers. Okay, I do a lot of off-market stuff, but if there's a call for offer scenario where it's a very competitive type of deal, they might say all the offers have to be in by Friday, and then Friday morning at 9 a.m., you'll find that all the offers will suddenly show up on Thursday at 5 p.m., right? Or even early that morning, right? So I try to get a feel for what the deals are looking like that come in, right? So and if you have a good rapport with the broker, sometimes it may even tell you, okay? So be ready to pay a price you'd regret not being able to meet, okay? So you don't want to have any regrets, right? Have a target, have an IRR, and what you need to pay to hit it. And stress test it, make sure your financial model makes sense, even at a higher price, and know your ceiling. And don't go over your ceiling just to win the deal, right? That's a lot of people do that. They end up saying, oh, it's only an extra $100,000, $200,000. It's okay. That'll erode your returns. Okay, so don't make that mistake. Stick to your numbers. Okay, that's a real big part of it. That's a real big part of it. I typically don't just offer enough to win. I make an offer that's very aggressive, right? Because I really do want to win the deal. If I really want to win the deal, I'll put an offer in that's aggressive. That makes sense, and they're going to want to sell it to me, right? The goal is to give yourself no reason to look back and say, I should have paid more for it if I would have known X, Y, Z. That's the goal, okay? That's the goal. Go in with your absolute best and final offer for real. Real estate is a very competitive business. There's no second place ribbons, okay? So you have to be aggressive with your deals. Don't be stupid about them, of course, right? You want to be smart about the deals you're putting together, right? But it all starts first with doing that rapid underwriting, then putting together an initial competitive offer, and coming up with a great way to structure a deal that makes total sense, okay? Now, another big part of it as you're negotiating is demonstrating your ability to close. And what does that mean? I like to know where all the debt is coming from. I like to know where all the equity is coming from. So that way when you're talking to the broker, you can tell the broker, my debt is already lined up. It's with this group over here, this lender broker out of New York or wherever they might be. And we syndicate our deals. We already have commitments from X number of people. We have cash to deploy. So we're looking for a deal and we can close fairly quickly. These are things that you're doing all along. Like, it isn't like you're waiting to get the deal in your inbox, right? You're working on building those relationships in the background. So when you do finally get your hands on a deal that you really want to execute on, you know where the debt's going to come from, you know where the equity is going to come from, and you can actually use that as part of your sale to the broker. Because again, the broker just wants to get paid. They just care about them getting paid. That's all they care about, right? So the more sure they are about you and your team on your ability to execute the deal, the higher the likelihood that you're going to win the deal. So I spend a lot of time talking to the brokers, having them get to know me, having them get to know where we're getting the debt from. I use a variety of different groups here to get debt, but usually the debt that we're getting is coming from companies that a lot of these brokers, at least here in town anyway, they're very familiar with. So they can pick up the phone and call that debt broker, and they know who I am, right? That's the type of scenario. That's the type of relationships that you want to build. You want them to, oh yeah, Joe's a good guy. He's executed X number of deals with us, and he's always great. He's always done on time. He always does what he says he's going to do. Integrity, very important, especially in this business. All right. So, in summary, we've got the 4 steps. All right. So rapidly underwrite those deals. All right. Filter them. Look for very, very quickly, and get back to the broker. Okay. Secondly, determine the fair market value based on real market data. Third, make a competitive offer with a strong pricing, strong terms, okay, that makes sense for the market and what's going on. And number 4, negotiate aggressively to maximize your chances of winning, right? Sell yourself, sell your team, show that you guys are the real deal and you can shut it down, you can close, all right? Now, listen, that's a lot of stuff we just covered here. If you really want to know how to do this business, how to really come up with a way to put these types of deals together, go ahead and check out themultifamilyadvantage.com, okay? In that 50-week mastermind, we go over how do you put these deals together? How do you find these deals? How do you build the rapport with the brokers? How do you build a personal brand so you can even get the deals in the first place? All those things are absolutely critical to putting deals together. If you've already done deals and you want to go scale up and do big deals, in that case, you should check out multifamilyaccelerator.com. Check out that website, okay? It's the same sort of 50-week mastermind. The difference is in that mastermind, we're covering how to register with the SEC, how to raise capital, like big capital, to try to get hands on millions of dollars to take down giant deals, right? How do you find the debt for these types of deals? And especially in today's market, finding debt can be extremely difficult. We cover all that stuff. Personal branding is extremely important as well. We take it a notch up, and we help you actually put together the entire website, your personal branding, your logo, all that, everything you need to give you what you need to build the credibility with your investors, with the brokers, with all the stakeholders in that deal. Again, another 50-week mastermind. Both of them are delivered online. You can be anywhere on the planet, and you can take part in 2 amazing communities that are on the same path as you are, right? So together, we can all win. We all make money, right? If you're interested in doing any of that stuff, check out those 2 websites. Or, you know what? You can just comment down here too, okay? If you're watching this right now on the live stream, you can comment there. Or if you're watching this afterwards on YouTube, go ahead and leave a comment. Tell me how much you like it, and we'll get back to you too. By the way, if you are on YouTube, please like and subscribe. It helps with the channel tremendously when you do. Hopefully you got enough value out of this. And if you did, please like, subscribe, give me some love, all right? Thanks you very much for tuning in, guys. I will see you next week. Take care.